What's the latest?
Well, Anna, things are looking rather grim for the cartel. They're saying that they expect they're going to need to not produce as much oil from the cartel is going to be needed, and that's going to project that their market share of global oil supplies will shrink. So the number coming out of this report, they expect that demand for its oil will slide by about 7% over the next 4 years to 2023. That's an average of 32.7 million barrels a day. And one thing they're talking about in this report is that they just remain under pressure, mostly from outside of OPEC. They say the main driver of medium-term non-OPEC supply growth remains overwhelmingly U.S. tight oil. That's another word for shale. But also there's Brazil, Norway, Canada, Guyana, Kazakhstan are also likely to contribute. So they're under a lot of pressure from these outside supplies, and that's shrinking OPEC's hold really on the market.
What does this mean for the production deal and the group's upcoming meeting?
Well, there's been a lot of talk that they're going to need to actually cut deeper than their current production quota. Mohammed Barkindo just in London last month said the group will do, quote, whatever it takes, very Mario Draghi moment, to remain that balanced market. But when you look at this report, it looks like it almost potentially this strategy is backfiring by making room for U.S. shale. This is something that a lot of investors have actually, analysts have actually said could happen. This is something that the former Saudi oil minister Al-Naimi has warned. He said if you just keep cutting and cutting and cutting, you're going to have a vicious cycle, and it just makes more room for the likes of U.S. shale and other supplies around the world.